The interpretation of accounts or ratio analysis lets us check out how well a firm is doing, and typically at either ordinary or higher level. It's question 5 in the leading cert, so that's what we're going to be looking at now in this section. First thing we look at are 4 profitability ratios. Profitability is the ability of the firm to earn sufficient income given its size, its sales and the amount of capital employed in the business. The first ratio we're looking at for Blue Limited is markup. Markup is gross profit as a percentage of cost of sales. So it's gross profit over cost of sales by 100 over 1. You know, A as a percentage of B is always going to be A over B by 100. So it's gross profit as a percentage of cost of sales, and in Blue's case the gross profit is 190,000, the cost of sales is 410, so that's giving us a 43.64% markup. Markup being profit as a percentage of cost. It's the amount by which you mark up its cost price to get the selling price. That's the origin of the expression, markup. It's typical in ratios and percentages to go to 2 decimal places, so you go to the third significant figure after the decimal point, and if it's 5 or more you round up the second figure. Now in our case here it's 43.64%. Whether that's good or bad depends very much on the industry that you're involved in. Another way of looking at gross profit is to express it as a percentage of sales. So margin or gross profit percentage is gross profit as a percentage of sales, so it's gross profit over sales by 100 over 1, and in the case of Blue it's 190,000 over 600,000, which is 31.67%. It's worth remembering that you can express gross profit as a percentage of either cost, in which case it's markup, or as a percentage of sales, in which case it's margin. The net profit percentage is more important, and it's net profit as a percentage of sales. So it's net profit plus interest over sales by 100 over 1. We add interest back to our net profit for reasons that I'll explain later. So it's always net profit plus interest over sales, and in our case it's 65,000 plus 9,900 over 600,000 by 100. Now where did we get the 9,900? You can't see it in the profit and loss account. You're told the expenses are 125,000 including interest, but if you look down to the balance sheet you'll see they've got 110,000 euro worth of debentures or long-term loans, and it's 9% per annum, so that gives us our 9,900. And it's 12.48% is our net profit percentage. The most important profitability ratio, or the primary profitability ratio, is the return on capital employed, which is our net profit, again with the interest added back to it, expressed as a percentage of the capital employed. So it's net profit plus interest over capital employed by 100 over 1, and in our case it's 13.62%. It expresses the profit as a percentage of the long-term capital invested in the business. And at 13.62% you'd make a couple of observations. You'd compare it with last year's figure, which we don't have, and you'd comment on the trend, and you'd always compare it with the return on risk-free investment, which is what you would earn from sticking your money in a deposit account, which at the moment isn't even 1%. So you'd look on Blue Limited as being a profitable firm because of that. The return on capital employed is far higher than the return on risk-free investment. Liquidity refers to the ability of the firm to pay its debts as they fall due. The debts that fall due are your current liabilities, and practically speaking you'd use your current assets or your liquid assets with which to pay those current liabilities. And examining liquidity, we look at 2 ratios. The first relevant ratio for liquidity is our current ratio, or also called our working capital ratio, and it's the ratio of current assets as to current liabilities. In our case it's 170,000 as to 70, and you divide both sides, if you like, by the 70,000 and you get 2.43 is to 1. You can see in the centre box there, I forgot to write down 2.43 is to 1. But you can see that our answer is that. That means that for every €1 the firm has in current liabilities or debts falling due, it's got €2.43 with which to pay them. It's much higher than the required or recommended current ratio of anything from 1.5 up to 2 is to 1. The most important test of liquidity is called the acid test, or the liquid asset ratio, or the quick asset ratio, and it's the ratio of current assets less stock and prepayments as to current liabilities. Usually in these exam questions there are no prepayments, so it becomes a simple matter of current assets less the stock that's in it. In our case it's 170,000 less 70,000. That's 100,000 is to 70,000 current liabilities, which is an asset test ratio of 1.43 is to 1. That means that for every euro in debts falling due, the firm has €1.43 in liquid assets with which to pay them. The recommended asset test is 1 is to 1, so our firm here has no problem paying its debts as they fall due. In credit management, we look at two ratios: the period of credit allowed to debtors, that's how quickly we can get our debtors to pay us, and the period of credit received from creditors, in other words, how quickly we pay our own suppliers. The period of credit allowed to debtors in days is debtors divided by credit sales multiplied by 365, and of course if you prefer the answer in months, your multiplier there would be 12. Our figures here would be 60,000 debtors in our balance sheet, and we had 600,000 worth of credit sales during the year. So that gives us a period of credit allowed to debtors of 36.5 days. Or more correctly, I suppose we should say our debtors are taking about 36.5 days to pay us. We may only be allowing them 30 days, but we're letting them get away with 36.5 days. The period of credit received from creditors, in days again, would be creditors over credit purchases by 365, and of course it would be by 12 if you wanted your answer in months. So here we have 70,000 over 420,000 by 365, and that tells us that we're taking about 61 days to pay our suppliers. Contrast that with the fact that we're getting the money in after about 36.5 days from our own debtors, so we're getting the money in more quickly than we're paying it out, which is a good idea. Nowadays the idea is that you try to keep your stock to a minimum so that you keep down the costs of servicing the stock, from insurance and looking after it for security. The smaller your stock levels, the less pilferage, the less deterioration. So the idea is keep your stock down to as little as you can get away with, so that you don't have too much invested in it. A common measure of how efficiently you manage your stock is what's called stock turnover. And stock turnover is the number of times per year that a firm sells its average stock. So its cost of sales over average stock gives you times per annum. In our case it's 410,000 divided by our average stock. Now it's the average of your opening and closing, so it's opening plus closing over 2, or half opening plus closing. So it's 410,000 over 65,000, which is 6.31 times per annum. The higher the better. So for example, if your stock turnover last year was 6 times, you're shifting your stock more quickly now this year, and that will be looked on as an improvement in stock turnover. Whereas if you had been having a 7 times stock turnover last year, it would mean that this year you're selling your stock more slowly, and that would be a bad